Hello and welcome to this week's edition of Econoday Unplugged. It's Thursday, the 4th of June 2020. Mark Pender is stateside, Brian Jackson joins us from Sydney, and I'm Jeremy Hawkins here in London. Better news on the COVID-19 crisis and the ongoing phased relaxation of national lockdowns continue to underpin hopes that many of the world's major economies are starting to head in the right direction. And that's reflected in the buoyancy of equity markets, as well as recent strong gains in the traditionally more risky currencies. Nonetheless, most leading indicators are still only pointing to a slower pace of decline, not an actual return to positive growth, and that despite a record collapse in output in March and April. And there's plenty else going on to offer reason for caution too. In particular, you don't need a good memory to recall that for much of last year, it seemed that investors were almost wholly focused on global trade, and recent developments here have been uniformly negative, notably the dramatic deterioration in US-China relations, which could ultimately prove to be a major threat to the global economic recovery. So with that in mind, let's head to the Southern Hemisphere and Mr. Jackson. Brian, do economies in your part of the world in general seem to be turning a corner? And apart from anything else, with terms like Cold War being bandied about, how's Hong Kong in particular holding up following Beijing's latest crackdown?
Sure. I mean, there is a lot going on, as you said, and it is very interesting to track the economic data at the moment because it's really showing you pretty clearly the impact of some of these moves, but also I think starting to provide a few signs that there might be a bit of recovery in the second half of the year. I guess I'll just start with the PMI surveys because they're obviously the most up-to-date readings that we do have. And they've just been out in the last couple of days, so they're fresh off the presses, and they, again, pretty interesting. China, obviously, China was when the economic impact hit first, and so they had very weak numbers a couple of months ago. But the PMI survey numbers, both the official PMI and the one that's provided by Market Economics, they have shown signs that China is starting to build a bit of momentum. Still way below the levels that we saw in terms of the level of activity at the start of the year, but at least picking itself up off the floor and starting to make some positive movements. So that's China. Okay, so China looks to be a little bit ahead of the curve in terms of where everyone else is, and then so what we're seeing with everyone else is that the data is still very, very weak, as you would expect from what we've been hearing and seeing in terms of the lockdowns of those economies. So countries like China, India, Japan, Hong Kong, Singapore, the PMI surveys this week, again, very weak. Also, Australia, when you look at all the monthly data coming out of Australia, very weak. Some just very striking numbers showing the absolute peak, I think, of the problems.
Hey, Brian, this is Mark. I have a question on the timing of the COVID impact on China. Now, that was early in was it January and February? Now, that struck separately apart from Hong Kong and Singapore and Japan, and completely an isolated month or so, just where the effect was in China?
Yeah, it was really seen in February. Of course, the problem with looking at Chinese data at that time of the year is also the impact of the Chinese New Year shutdowns. But yeah, I think it's clear there was sort of mainly the biggest impact was in February, and then elsewhere in the region it was more like a March, April story.
Okay, now I have another question on the one you were talking about, the PMI that was produced in conjunction with Market Economics. Is that called Caixin? C-A?
Yes, yeah, in China it is, yes.
Now,
it has a different sort of sponsor in different markets, but yeah, that's the Chinese one.
Is it still is that Caixin still a semi-official organization? And you know what I'm getting at.
I do know what you're getting at. I think that's sort of a semi-official organization, but so you make your assessment of what that means. But generally speaking, I think the market PMI surveys have had a pretty good track record of being a reliable indicator. So I still do like to pay good attention to what those surveys are saying. So
In
Sorry,
terms
go
of
ahead.
it's in terms of the actual COVID numbers themselves out of China now,
Yeah.
is there the view out there that it's kind of all over, or is it the case that they think it may be over and there's still a risk of a second wave? What's the kind of overall sense out there? Because this is, I suppose, for a lot of other countries, what's happening out there, other countries are hoping may well be the case in their neck of the woods as well.
I think that they do have ongoing concerns that there could be a secondary wave, but at this stage that hasn't eventuated, I don't think. And again, people do have some skepticism about the actual numbers that go out there, but it doesn't look like we ever had a big public health problem in some of the other major cities, Beijing, Shanghai, and in other parts of the country. So that gives a bit of confidence, I think, to the overall situation. And again, what we're seeing, I think, across the rest of the region, are significant public health improvements. Whether Hong Kong has had a very great results from this pandemic. I think Taiwan, Korea, Japan, they're starting to see improvements. And down here in Australia and in New Zealand also, we can see the light at the end of the tunnel as well.
In terms of Hong Kong, I've got to ask you, I mean, this latest, the crackdown, there's a lot of talk, I suppose, out of the Western press suggesting that this could be a major problem now for Hong Kong in terms of its reputation and its standing as an international financial centre. Is that the sense within Hong Kong as well?
Yes. From the business community, that's definitely a concern. I think from the broader general public, they have just more immediate concerns about what does it mean just for, the governance and the judicial system there in Hong Kong. So yeah, it's definitely a major issue, and this is just sort of the latest thing that has actually hit, the Hong Kong economy for a couple of years now. So, the PMI numbers that come out of Hong Kong have been, indicating contraction in their economy for well over 18 months. They had the US-China trade disputes. Then they had all the civil unrest that took place in Hong Kong last year. Then you had the impact of the pandemic across the region hitting the economy, and now you've got this latest development. So, yeah, it's really been a very tough period for the Hong Kong economy, and it's really hard to see how it gets back on its feet anytime soon.
Has it hit the currency at all?
Well, they have maintained that link with the US dollar pretty consistently. So it hasn't really been seen there. They've just been sort of moving with whatever the US dollar does. So that's sometimes provided a bit of support to their competitiveness when the US dollar is weakened over that period. But it hasn't really had a huge impact yet.
Has there been any? I guess over the 40 years or so they've had that peg, there's been a couple of attempts to bust it by speculators. Is that works, or is that anyone talking about that?
No, I haven't heard a lot of discussion about that at the moment. I can remember that there definitely have been times over the journey where you have had a lot of discussion about it, and it's come under a bit of pressure, and the Hong Kong authorities have had to to step in to defend that peg, but it doesn't seem to be a great sense of pressure on it at the moment. So, it's just really means that the only tool that they have available to them is fiscal, and so they have been doing a fair bit on that front to try and support the economy, but the headwinds are just so strong at the moment.
Okay, thanks for that. Quickly, your part of the world, literally Australia. It sounds as if the RBA was just a little bit more positive in terms of its latest comments.
Yeah, probably even a little bit more than a little bit more positive. I think they are seeing, we are starting to see a bit of confidence amongst officials and sort of the business community as well that, there is going to be a decent rebound in the second half of this year. As I said earlier, the data that we're getting right now is very weak, and just shows the scale of the impact in the first few months. But the good news is that we have had a lot of progress on the public health front. And what that means, of course, is that restrictions on households and businesses are getting eased at a pretty consistent pace. You've also got the policy response that was delivered in over the last few months. You'd expect that to kick in over the next few months as well. So there's starting to be a few tailwinds, I think, for economic activity in Australia, and hopefully we will see a decent rebound by the end of the year.
Okay, let us hope so. Okay, thanks for that. Right then, Mr. Pender. Of course, it is employment week yet again, it seems already.
Yes.
So how bad this time? And I've got to ask you, I mean, what chance that it's going to be overshadowed by this current political unrest? And I suppose I've got to ask also, what chance are these protests of actually having of impacting the data if they continue?
Well, that was a greater question. The George Floyd protests a couple of days ago, or actually maybe just yesterday. But last night the looting quieted down, and so if that continues, I would imagine the economic impact will prove to be limited. We didn't see any in the weekly store sales Red Book report, any contraction, but in line with prior weeks of contraction. So I don't imagine that the social unrest will have much impact on the data. But as far as the data already is going to be extremely weak. We didn't have motor vehicle sales pop up in May. Those numbers came out yesterday, and that was a bit of a surprise. So, but the rest of the retail sales sector is probably going to be deeply in contraction again, as the jobs market is. For the Friday's jobs report, today, Thursday, we had jobless claims, and they came in just under 2 million. Let me just double check that. And that number has been consistently coming down, 1.877 million. But over the last, since mid-March, when the COVID effects started in the labor market, 43 million Americans have filed claims. And for payroll jobs, apart from self-employed or contractors, we're looking at the candidate consensus as contraction of 7.725 million for May. That would follow 20.5 million in April, with the unemployment rate almost expected to be up about 5 percentage points to 19.8%, just under 20%. So what's interesting, or not interesting, what is sad or unfortunate, is that even though restrictions are beginning to be lifted here, and it hasn't helped control job destruction very much at all. 2 million jobs a week are going out the door. So that is the idea that, and I think the markets the stock market are, that we'll get a nice, clean, neat, and tidy bounce back. I'm not so sure. I think there might be, structural changes in the labor market, and that will not only reduce demand because people have fewer jobs, but also reduce the amount of products and services. And we've been talking about inflation. If there's fewer products and services, that could be inflationary. And I'm not sure people are thinking on those lines yet. Certainly the policymakers here in the Federal Reserve don't see much risk at all of inflation, even though the consumer expectations readings that we're getting from the University of Michigan are going through the roof. And that is in complete diametric opposite of actual inflation numbers, which have been going down. Now, did I see an inflation expectation number out of Europe that was also going up, Jeremy?
Well, I mean, it's interesting too in terms of inflation expectations because for Europe, because of course we had the ECB announcement over here today, their June meeting, and within that is quite interesting because they've actually slashed their inflation numbers quite considerably. So as far as these are the headline numbers, but as far as 2020 is concerned, they're now looking for an annual inflation rate of just 0.3%. That's down from 1.1% in their previous forecast just 3 months ago. They've only got it at 0.8% in 2001 and 1.3% in 2002. So if you take that literally as far as ECB policy is concerned, it simply means that the current stance is not expected to achieve the inflation goals, which is the HICP inflation measure being close to the 2% mark. So it would appear to be, at least as far as central banks, and so this is certainly true of the ECB, but it's also true of the likes of the Bank of England as well. The general view over here is that the COVID-19 effects, at least over the foreseeable future, they expect to have much more of a dampening impact upon the demand side rather than the supply side. So it tends to mean that we'll end up with an output gap, which means that inflationary pressures per se are going to be moving towards the south rather than the north. And that appears to be how policy is currently working over here.
What did you make of the ECB expanding, significantly expanding their asset direct buying program, even though it doesn't seem to be in the same program it was before? And also, what did you make of the market's reaction to it?
Well, I've got to say, I mean, I suppose I've tended to be quite hard on the ECB in the past because I think they've tended to be, if anything, well behind the curve in terms of what financial markets and economists have been expecting. But to give them credit, I think they actually came out and made quite a good fist of it today. So what they did then, they didn't do anything with interest rates, which I don't think anyone expected anyway, because to all intents and purposes, I think that interest rates, as far as the ECB is concerned, have effectively reached their bottom. So we've got a deposit rate down at 0.5%. In terms of bank borrowing from the ECB, if the banks actually go out and lend as the ECB wants, that minus 0.5% can be reduced as low as 1%. So effectively, I think now they really are giving away money into the financial system at the moment. And I don't think they want to do any more of that because of distortions it caused, and we talked about on previous podcasts. But what they can do is, of course, is to change their quantitative easing. Now, today's meeting, I think, as we touched upon previously, was an important one because it took place against the background of this ongoing dispute with the German High Court, which from its own perspective regards the asset purchase program, or at least I should say that the public sector asset purchase program within overall quantitative easing. The German High Court thinks it's effectively illegal, and they don't think the ECB should be buying as many bonds as they are. However, a completely separate aspect of quantitative easing is their pandemic emergency purchase program. There's lots of anachronism using this, obviously. But anyway, what the ECB decided to do today was to boost this so-called PEP program, which isn't covered by the German court ruling, and they came out and reduced it quite significantly by 600 billion euros up to a current total now of 1.35 trillion euros.
They increased it, right?
Yeah.
Now, why is it separate? Is it the effect on the market going to be the same? I mean, if they're going to be, are they going to be buying different kinds of bonds in this?
In many ways, not really. I think what it is, it was introduced because they wanted to introduce a completely separate aspect of quantitative easing, or at least a different vehicle. Although ultimately it comes down to the same sort of thing in terms of the assets they're going to buy, but they wanted something which was separate, which was purely and simply associated with the COVID-19 virus. So as and when the coronavirus is finished with, then they can simply withdraw the PEP, the PEPP, and just continue, if they want to, with existing asset purchase program, the APP. But because in particular this time round the politics were involved, by using the PEP and increasing that significantly and crucially by more than markets were expected, they've been able to provide what could well prove to be a significant stimulus to the Eurozone economy, which certainly needs it at the moment. And at the same time, kind of indicate to the German High Court, well, look, we're maintaining our independence. If we want to increase quantitative easing, we're going to do it, even if you don't like certain aspects of our economic policy. So I think it was important, and it was interesting to see how, as you mentioned, how some of these markets reacted. For a start, we saw the euro rally on it. And I think that's a reflection of the fact that it was a larger stimulus than anticipated, so that much more beneficial for the Eurozone economy. And in particular, we saw some significant improvements in what they call the peripheral Eurozone bond market, so the likes of Italy and Spain and Greece. And that's because a lot of the purchases coming under the PEP program will be directed towards those countries, those bond markets, which have been most under pressure. And that's clearly going to be the southern Mediterranean bloc. So I think on the whole, they've actually managed this, I personally think, quite nicely. I think by and large, the markets themselves have taken it pretty well. And I suppose it's worth mentioning quickly, without spending too much on Eurozone policy, we've had quite a lot going on in terms of the fiscal side as well over the last week or so. And by that I mean we had the EU Commission announce last week that it would be at least trying to launch what it wants to call the Next Generation EU Fund. Now this thing raises a previously proposed Franco-German package of stimulus, which was worth 500 billion euros to 750 billion, which is in itself good news because it's more positive for the economy. And more importantly, in some ways than that, it's going to be financed in the capital markets. So it actually represents a major step forward in terms of movement towards a pan-European fiscal policy, which is certainly something that ECB's wanted to see for a long time. And again, it's particularly good news for the heavily indebted countries like Italy, because they're going to benefit disproportionately from the various handouts. However, being the EU, of course, there's always difficulties and problems on the road. And in this case, we still have this so-called frugal four, by which I mean Austria, Denmark, Sweden and the Netherlands, who think that the disbursement really should be tied much more to loans rather than grants. So it's not actually certain it'll actually get through in the first place. There's an EU leaders meeting set for June the 18th and 19th of this month, where we'll have the heads of the various governments discussing what's going on. But it seems increasingly like if this programme is actually going to be passed through and delivered, it's going to take a long time and it's going to run well into August, if not beyond that. And I think that's one reason why the ECB opted to do what it did today, simply because although the fiscal side on a pan-European basis is gradually evolving, it's doing so too slowly. And just quickly to round off in terms of fiscal policy in Europe, in some ways almost more importantly on a short-term basis, there's been developments going on with Germany, which has really taken the lead, I think, in terms of trying to reflate, well, obviously its economy, but also the Eurozone economy as well. And Angela Merkel looks like she's managed to agree an additional over about 130 billion euros worth of fiscal stimulus for the German economy. That's going to include a cut in VAT by 3 percentage points. And going back to your point about inflation, well, of course, a cut in VAT is going to have a direct impact on inflation in Germany. And I guess off the top of my head, it could, if it's passed on fully, reduce inflation by Germany, about 1 percentage point or so, or something like that. So we're talking about a zero or negative inflation rate in Germany as a result of this. But we do see, in particular, national governments across the Eurozone going down their own routes simply because at the end of the day, they're not convinced that a pan-European fiscal policy is actually going to work. Okay, that said, what else have we got? I should mention Brexit from my side, I suppose, because we had the fourth round of the Brexit talks kicked off yesterday on it's Tuesday. At the moment, I must say it's a real worry for sterling markets because they don't appear to be really getting anywhere. And it's particularly important because we're running out of time. I think for a lot of investors, they're well aware of the fact that Brexit, if we don't get some kind of trade deal, would be extremely bad news for both the UK and the European economies. And that really then means that with this COVID-19 crisis, adding to the downside potential to economies everywhere, they really want to get a deal if they can do. So the UK government's attitude currently still appears to be, well, look, if we haven't got basically really solid progress on some kind of the post-Brexit trade deal by the end of June, and the transition period will at the moment ends at the end of this year, then Boris Johnson is prepared to walk away. And that would be extremely bad news. Now, of course, it may be politicking, as we've seen previously in the past in all these Brexit negotiations, but it's something which for sterling markets is going to be particularly important over coming weeks. So just to remind people that ultimately the UK, we've left the European Union, but to all intents and purposes, we're still part of it in terms of the way trading links and so on operate at the moment until the end of 2020. Once we get into 2021, the UK really will be on its own.
So what do you think is going to happen?
I've got to be honest, my own bet is that both sides, I would hope, are sensible enough to realise that a no deal trade Brexit now would be absolutely disastrous, in the sense that it's not as if we're working in normal times. We're talking about a Eurozone economy, a UK economy, a global economy, which has been hit massively, unprecedentedly by this coronavirus. So to add the uncertainty associated with what's going to happen to Brexit and no trade deal would be absolutely disastrous. So I think, although we've got on paper these various deadlines dotted over the next several months, I think they'll keep talking, and I would hope, I really don't know, your guess is as good as mine, but I'd hope by the time we get into sort of close to the end of the year that they'll come out with some kind of agreement which is going to involve compromises on both sides, but hopefully actually ends up with something, with a trade deal which does not upset the markets to the extent it certainly could do if they don't get one.
Are there other major trade deals in the pipeline for the UK?
Well, the UK announced as soon as it came out with the idea, they wanted Brexit, was that they'd be looking for trade deals, improved trade deals with the US, with the likes of India, certainly with your part of the world, the Australasian side. But one of the big issues has always been, as we've seen in the past, trying to actually get hold of a concrete trade deal. Typically takes a matter of years rather than months. So it may well be possible for the UK to actually, to achieve something in the longer run. But over the course of the next, several years, it could well be that, net exports for the UK get absolutely hammered, because ultimately the European Union is our most important trading partner. So I think, from an investor perspective, they really, really, really want to see a trade deal. I mean, ultimately, if we go back to last year, looking at how the pound traded, literally it came down to how the latest news related to whether or not there's going to be Brexit or no Brexit, or whether it's going to be a soft Brexit or a hard Brexit. Well, now we know we've got Brexit, but we still have the uncertainty about whether it's going to be with a trade deal or without a trade deal. So it is going to be a key focal point, I think, once markets start shifting towards looking at that, rather than, let's be honest, at the moment, almost solely concentrating upon what's happening to the coronavirus numbers. Right, what else have we got, or should we be mentioning? I suppose I should mention the fact that looking at slightly positive news out of Canada, there's no change out of the Bank of Canada in its latest meeting in terms of interest rates, but it does seem to be dipping its toe in the water of looking a little bit more optimistic about the way things are going. Canada, like most of the world, has been hit quite hard by the coronavirus, but they have announced now that they'll be reducing their frequency of term repo operations to once a week rather than twice a week. And they're also going to cut the program which involves purchasing bankers' acceptances to bi-weekly from every week. So it's one of these, I suppose, central banks, part of the G7, which investors do look at, and they're obviously taking the view now that perhaps the worst is over. Markets are starting to function that much better than they did before, and so watch this space. A bit of luck, we'll see other central banks doing the same sort of thing. And I suppose on that note, I mean, in terms of Brian and Mark, your side of the world, is there anything coming out? I mean, we know, like me, the likes of the Fed have boosted their balance sheet like there's no tomorrow. The RBA's been doing its own stuff. Has there been anything coming out of there which suggests that, I know I mentioned the RBA earlier being a little bit more optimistic, or perhaps quite a lot more optimistic. Is there anything which suggests that they're actually getting to the stage whereby they're thinking about scaling down their monetary operations because they're believing now that they're getting past the worst?
Not in the US.
Not in the US.
Not really here either. I think they're just playing it very cautious and hoping that what they've got in place has the desired effect, but they're not going to guarantee, assume that's going to happen just yet.
Here, troubles are their description of future troubles are still very severe. So until they start toning down their outlook or improving their outlook, there's no indication yet of any light at the end of the monetary policy tunnel.
Yeah.
And what you're actually seeing in India is they're quite explicitly saying we don't really care about inflation. If inflation picks up, that's not really our number one focus at the moment. We just want to, get activity, recovering to some extent.
Yeah, perhaps that's an issue of another podcast, but I think you're right. I mean, it's going to be interesting as and when we do start to get inflation coming back for whatever reason. Will the central banks now react to it, or do they take the view that we've got to make sure first that these economies have actually turned the corner? Okay, right. Well, anyone for anything else?
I think that's it.
That sounds promising. Okay, thanks. So that's it for today then. We'll be back next week. But in the meantime, remember, you can always keep on top of all the key data and events in Econoday's global economic calendar. From Mark, Brian and myself, thanks as always for listening. Stay safe and we'll see you next time. Bye for now.